Okay, excellent. I think the recording has started. So, welcome back, everyone. Like I said, I'm really sorry that it has taken this while. Well, not my fault, but due to the situation. And like I said, of course, the main reason is we could have completed when the rest of the classes have completed when we use a different approach. But, like I said initially, I was trying to ensure that you don't have only the accounting knowledge, but also the expressive knowledge which is relevant to your career. Okay. So we are resuming today, and this is the plan. We have class today. Tomorrow, Thursday, also we have class. The same time, that's from 5 to 7. And on Saturday, which time did I state on the text on Saturday? Which time? I forgot. Which time was it on Saturday? Can anyone remember?
3:30. 3:30.
3:30. Okay. So we can start from 3:30 until we finish the syllabus. So I really want us to finish the syllabus on Saturday, so that we can discuss on Saturday. We will discuss the exam day.
After 3.
Yeah, after 3 classes, yeah, inshallah, we will finish the syllabus and we will discuss the exam. Yeah, maybe in a week or 2 weeks, depending on you. Okay, because I understand some of you are graduating, so to do justice to them, it shouldn't take much time. Right. So where we stopped the last time was break-even analysis. Okay, we were looking at our main topic, which is accounting for short-term decision making. Okay, accounting for short-term decision making. I know towards the end, the last 3 classes, there were a few people attending, but if you missed those classes, please go to YouTube. I have got all the videos uploaded there. So go to YouTube and then you can watch all the videos for all the previous classes. They're all there. Okay, so is it calling me this time? Let me put my phone. Hello? Hello? Class, can you hear me? Hello?
Yeah, we can hear you.
Yes.
Yeah. Sorry, yeah. Okay. Somebody tried to call me, and my phone is connected to my laptop, so that was disturbing. But anyway, I made it, on airline mode now. So, like I said, our last lecture was on break-even analysis, which is under the main topic, accounting for short-term decision making. We looked at the following topics: make or buy decision, short-term shutdown decision, limiting factor decision, further processing decision, and the last topic we looked at was on break-even analysis. So, like I said, in case you missed any of those topics, you can go to YouTube on my channel. If you've been following it, I've been sending them on the WhatsApp forum. In case you're not able to do that, you can just go to YouTube and then type my name, Lamin Fofana. It will appear with my picture. Then all the videos will be there. Okay, so you can do that. So we're going to continue with break-even analysis today. Just we're going to continue from where we stopped the last time. I understand some people were requesting that we go through the question we last did, which was on Canis poultry. Okay, so we're going to look at that quickly, and then we'll move on to break-even analysis for multiple products. Then after that, we're going to look at relevant cost analysis, which is a very short topic. And then last but not the least for today will be on accepting or rejecting orders. Okay, so this is what we're going to do. And hopefully tomorrow we're going to start accounting for long-term decision making or investment appraisals. Okay, is that clear, everyone? Is that clear, everyone?
Yes, it's clear, Mr. Fuller. Yes, it's clear.
Oh, excellent. Right. So, break-even analysis, of course, we dealt with it the last time, just to refresh. We know break-even analysis is very, very important in decision making, is very, very important in business planning, as we have seen the last time. So break-even analysis, of course, is
it is fair.
The organization tries to know how many products it has to produce, how many products it has to produce in order to make, in order to be at equilibrium. No profit, no losses. Okay, so how many products an organization needs to produce so that the cost and revenues will be the same. Okay, so we said this is very, very important because we have to know from onset, how many units do we have to produce to make a profit. So if you are able to calculate your break-even units as a business, in fact, even before coming into being, you'll be able to know if I produce this much, I will make a loss, or if I produce this much, I will make no profit, no loss, and if I produce this much, I will make profit. Okay, so it's really, really important for decision making and business planning. Okay, so that's what we said the last time. So we looked at a typical question which is projected here. Can you see this question? I've projected it. Canis poultry?
Yes, sir, we can see it.
Okay, good. So we've done this question. We are not going to go over everything. I'm just going to explain to you how we went through it. The solution is already, it has already been shared with you. If it has not been, if you have not got it the last time, I'll share it with you again. Okay. So this is the question. Canis Poultry wants to invest in production of broiler chicken. The farm has a capacity to produce 1,000 birds for a period of 6 weeks. It takes 6 weeks for chicks to mature and be available for sale in the market, and the selling price shall be $250. The following cost table was provided by another organization, which is Common Poultry Farm, for the same 6-week period. Okay, so we've seen the various costs, how they are broken down into their various components and into their fixed components. That's what is of interest to us. If you want to calculate your break-even analysis, you must know which costs will be variable and which costs will be fixed. So it has all been categorized here under the third column called cost category. Okay, so you're required to advise the MD of Canis Poultry as to the number of birds to produce within the specified period to break even. Okay, so that's the first part. Then the second part is to justify your above answer, produce a profit statement using the break-even quantity. And the third question is, what is the margin of safety? Okay, so this was the question we looked at the last time. So I'm going to, for the sake of time, to be honest, if we want to go through all this, we'll not be able to cover what we are supposed to cover. Since we have done this before, so what I'm going to do is I'm going to project the answer and I will explain it. Right. So make sure you have this handy. I'm going to project a different screen. Right. So I'll stop projecting this. Then I'll come and present. Oh, where are we? Right. Subtime decision making. Right. Okay. So this was the question we did. So we know in order to calculate our break-even point, we have to know a couple of things. The first thing we have to know is we have to know what are our variable costs. Two, we have to know what are our fixed costs. So if we know those, and the third thing we have to know is what is going to be our sales or our unit selling price. So we know from previous knowledge that in order to calculate a break-even quantity, we usually take the fixed cost divided by the unit contribution. The total fixed cost divided by the unit contribution. Okay? So the first thing we have to do is to find our unit contribution. So in the question, we have been given, let's see, where are we? In the question, we have been given the various costs, and whoever said the question must have been very generous to categorize them into their various components, either fixed or variable. Okay, so which makes life a lot easier. So when you look at it, we know from the cost table that the first items are all variable. Okay, and the best thing to do is to find the total variable cost, and we divide it by the total activity level. In this case, our activity level is the number of chicks to be produced, and the number of chicks to be produced is 600. So we find our total variable cost. Our total variable cost is here. Okay, in fact, the same question is here. Okay, so our total variable cost starts from here, that is from H10 all the way to H19. Okay, so we're going to add all of them. So that's the formula that we did here. Okay, we say equals. We link it to this sheet here. We did the sum formula from here to here, and then that gave us a total of 84,900. So the total variable cost is 84,500. Sorry, 84,900. So if we want to find the unit variable cost, is that total variable cost divided by the unit of 600. So which gives us 141.5. Okay. The selling price have been given to us on the plate. Okay, which is 250. And then to find the contribution, we all know that it is the selling price less the unit variable cost. So our contribution will be 108.5. Okay, so that's our unit contribution. Our total fixed cost we have to calculate. Okay, when we come to our cost table, we know that the fixed costs are these ones. Okay, from H20 to H23. Okay, so if you add all of them, so that's what we have added here. Okay, H20 to H23, that gave us our total fixed cost of 37,750. So we know our break-even quantity is equals to our total fixed cost divided by unit contribution. Okay, so total fixed cost, which is this, divided by unit contribution. So that gave us 347.93 birds. 347.93 chicken. So if we have to round this, we can never round it up because these are chicks, these are animals. You can never have part of it. You either have a full or you don't, or you have nothing. So we cannot say it's 347.9, we round it up to 348. No, we rather round it down to 347. So in order for Canis Poultry to break even, it has to produce 347 bars. So that means the layer bars that it has to buy has to be 347. So from onset, we all know that if they buy 347, they will be at break even. So what happens if they buy less than 347? What happens if they buy less than 347 quantities? Class? Are you with me?
Yeah.
Yes, but yes. So what happens if they try to produce less than 347? By buying means, of course, producing, because we know those who do poultry, you buy your day-old chicks and then you try to feed them for a period of 6 weeks, and then you start selling them. That's what I mean. Yeah. So how, if they try to rear, or if they try to purchase, or if they try to produce, by producing meaning, they're going to give them food until they grow to an age whereby they will be sold for good money. So if they buy less than 347, what's going to happen, Mr. Baji?
Well, to my understanding, they'll be running at a loss.
They will be running at a loss. Good. They will be running at a loss. Okay, that is it. If they buy anything less than 347, then that means the business will just be, wasting time. Okay, the business will just be wasting time because they won't make any profit. So there and then you know that, look, I have to start with at least 347. If I start with anything less than 347, I'm going to make loss. So what about a situation whereby they buy more than 347? What's going to happen? What's going to happen if they buy more than 347?
They'll make profit.
Oh, sorry. Okay, yes. Basin, yes. What's going to happen to them?
They will make
profit.
They'll make profit.
Exactly. They will make profit. Yeah, they will make profit. Excellent. So the next part of the question is the profit statement, which is a lot easier. So the profit statement, what we're going to do is we're going to multiply the unit sales by the quantity, which is 600. That gave us 86,750. The variable cost is going to be the variable cost for this 347 units, mind you. Okay, so the variable cost for this 347 units will be what? 49,100, and as such, the contribution will be 37,650 rounded up. And fixed cost, will the fixed cost change? Will it change?
No, it will not change.
No,
because it's
it will not.
Because it does not vary with activity level. Whether you produce 2 chicks, whether you produce 1 mil, how to call it, these variable costs will have to change. The fixed cost will not change. Okay, because these feeders here, the drinkers, and so on and so forth, this in fact will be fixed assets, which obviously will not be counted as variable cost. Okay, so right. So now when we look at it, the profit or loss gave us minus 100 because of rounding up. The profit or loss should have been 0. But because we did some rounding up, when you look at it, even the number of bags have been rounded down. So because of rounding off difference, it gave us minus 100, but it should be 0 actually if there were no rounding up. So the third part of the question is margin of safety. So what is margin of safety? Margin of safety is the area between the break-even quantity and the maximum sales quantity. So in our case, our maximum sales quantity, that's the capacity, is what? 1,000 bags. So the margin of safety is from 347 to 1,000. So meaning if you produce any quantity above 347 up to 1,000, you are going to make profit. So the closer you are to 1,000, the more profit you make. Okay, so you can express this margin of safety into percentage, taking the difference divided by the initial figure multiplied by 100. Okay, so and it can be in quantities as well. Okay, so this is what we have done. Please go through it in your free time. I'm sure you're going to understand it more. Margin of safety, contribution analysis, break-even analysis are all, easy concepts. Okay. So shall we move to? No, in fact, we have more break-even analysis. So let's go. Right. So let's stop this one. Let me project. Okay, so let's just go ahead with other parts of break-evens. These are some of the limitations of break-even analysis. Okay, you can look at them. Fixed costs, break-even analysis assume that there will be a linear relationship, between revenues and, of course, cost. That's the variable cost. Okay, which, in actual sense does not happen. Okay, so these are assumptions which sometimes may not be true. Fixed costs, break-even analysis also assumes that fixed costs will be constant over the relevant range. Okay, and it may not be constant. Look at the situation with some of our fixed costs that some of the costs we've categorized as fixed costs, like the feeders and the drinkers. At some point, this may vary with the number of parts. You agree with me? Okay. Sometimes if you want more bars, if you want to rear more bars, that is more chicks, you definitely have to buy more feeders and drinkers. Okay, but in this situation, because they are fixed assets, they're going to, of course, last for more than 1 year. So you cannot categorize them under variable cost. Okay, so but when you argue much, you could, partly say they may be they may not be fixed costs. Okay, so it assumes that variable cost will vary in direct proportion to volume. In this case, the variable cost of the feed may be directly proportional to the number of parts. This may sometimes be the case, and sometimes it may not be the case. Okay, the selling price or the market price, we assume that will remain unchanged, which may not be the case, because when you look at the period before Corona, and now when you look at the selling price of chicken, there is a bit of difference. Okay, because during this period, during the pandemic, it was very difficult getting the chicks from Senegal to here. So because of that, the cost of the day-old chicks have gone up, and as such, the selling price also have gone up. But when you're doing your break-even analysis, it assumes that selling price remains constant. Okay. So how do we apply a break-even concept? Well, we've been talking about it all along. When you're doing your business plans, one of the things you must never miss is your break-even. Okay, your break-even analysis must be part of your business plan. Of course, we all know what a business plan is. This is the plan that is prepared before you start your business, because this is the plan that will tell you whether your business is viable. Yeah. So, as part of the budgeting process before implementation, break-even units to be calculated before producing any products, executing any service. So, as a matter of budgeting process, also we consider break-even analysis. Okay, so it assists in making choice of products and determine the product mix. So once you are up for producing different varieties of products, and you have done your break-even analysis, it may allow you to choose which products will break even quicker, and which products will break even later, and then as such you can be able to do your choice. And of course, it's very, very useful for evaluating profitability of businesses and product lines. Okay. So margin of safety, I've explained it. So it's the area of cost between the break-even point and the maximum sales quantity between 347 and 1,000. So that is, if we produce 348, we're going to make profit. If we produce 400, we're going to make profit. If we produce 500, 999 up to our capacity. So the higher we go, the higher we are closer to our maximum capacity, the more profit we'll make. So like I said, you can express it in percentage. Yeah. So shall we move? Any questions? We're going to look at break-even analysis for a multiple product. Okay. If you're going to have more than one product, how do you calculate the break-even point? Okay. Shall we? We good to go? Are you with me?
Yes, sir.
Okay.
Yeah, sure.
Shall we move? Shall we?
Yes, sir, we can.
Yeah, you can go ahead.
Okay, excellent. Good. So let me stop this so that the recordings are not too long.